Hello, friends. How are you all today? Welcome to Financial Literacy Made Easy program. Uh, Through this, we're going to learn how to be wealthy, earn passive income through smart investments. Today's topic is about the inflation. So we know it's a globally everyone is talking about inflation is a hot topic. How the inflation is affecting the country and the people. Let's go through in detail. So, actually, let us know what is inflation and what causes inflation. Inflation is a general increase in prices and fall in the purchasing value of the money. What does it mean? Is inflation is the rate of at which the prices for goods and services rise. So, whenever the inflation goes up, like you don't notice that the inflation is high, and then the bank rates are increased, fuel cost has been increased, the commodities has been increased, the gross. Especially notice that when you go to day shopping to buy groceries or fill up that fuel. So this is what you see the effect of inflation. But inflation is not a new thing; it's already there. But it's only the low, high. That's all matters. And every country has a different inflation rates. Depends on the percentage. So depends on the country economy how they're performing. For instance, there's a natural way of inflation is within every country has it. It's up and down. How it acts is like three major categories we can discuss on this. There are but various causes. So three major causes are demand pull, cost push, and then built-in inflation. So let's say what is demand pull. Demand pull is the one like when there's a supply and demand. There's no much supply and then demand is high for the products. For instance, in pandemic time, we didn't have sanitizers and the supply was less and the price of sanitizer has gone up. It was like a small bottle of like 30 ml bottle for $1. It was like nearly $5 to $10, depends on where you buy, in which country you buy. So that's a, demand pull one. If you go to the cost push, is the one where the increase in the production costs or wages, raw materials, or importing duties. Say, for instance, at the moment, like we can notice in Australia, during after the pandemic, during the war time, in like 2021 to 2022, the building cost has increased. The building material was there's no enough supply, and importing duty was high. So at that time, the products building materials has gone up, the building cost has gone up as well. So that's the cost push example. And what is built-in inflation is occurs when the um, like wages or the products in the manufacturing product goes up. Like how it goes up, like example is if you have a union trade strike and then the increase in wages, then the manufacturing increase the wages of that because the workers demand for it. So when the wages are increased, automatically the cost will be added on to the product and be sold at higher rate. So end consumer, like end users, buy at the high price. So that is also cause inflation. What other causes? The major thing is the unexpected sudden causes. There are all the natural thing happens in every country, but this is the few of the ones which has major impact like a war, natural disaster in the country, unstable government, poor economic policies in the government. So, for instance, if you go with the war, like war is a long term, it's not a short term one. So, when you have a war like Russia, Ukraine, what is going on, most of the supplies has cut down, like price increase in the fuel, especially. So importing duty has increased, so that's impacting globally. Actually, war impacts globally. That. So that's how the inflation. Through inflation, we know that it's increased. So and natural disaster. If any country has a natural disaster, like earthquakes or flooding, so that's other cause where there are a lot of damages to the industry. So that's how the price going to go up because the import duty will go. They have to import the products and takes time to for the production. And unstable government is in most of the countries they have the like we see the political drama. Like if a government is formed and they run the government and if they don't perform well, then other opposition party like they do re-elections and new party comes in, and what are the old political party has implemented the project they started, they will be stopped in the halfway or could be stopped completely, and the new project starts, a new budgeting starts. So that's the instability, economic instability. That's also poor leads to inflation and poor economic policies. That's everything. They have to have long term strategy, like how we plan for our financial planning for individual. The country also has to plan in the long term. So it will affect, like maybe in 50 to 60 years time down the track, if they don't have good economic policies in the place. And the other thing which a bit out of topic, but I want to add it is very important, printing money. So people ask me about, like, do the governments print money during the pandemic or any other emergency situation? So yes, the good example is in a pandemic is an emergency situation. In that emergency situation, Austrian government has printed money. So why they have to print the money? Like, see the lockdown period, people and businesses shut down, and people are like locked out at home, and they need income to like live for to buy the essentials. So at that time, government, RBA wants to buy the bonds. People who buy bonds, like bonds are nothing but people lend money to the governments and buy like a promissory note. It's a guarantee that's called bonds or bills. So what happens is RBA buy the bonds to run the country at that time. So when they don't have enough money to buy the bonds, so they print money and buy the bonds to run the country. When they print the money. That's one of the situation, but it's like a secondary economic, they say, which is not a good, and that printing money also causes to rise in inflation. And let's see the difference in the current situation, like the inflation rate. So, very very good example. Like inflation is already there since 100 years and more than 100 years we see. But if you compare like the war and the at the moment Ukraine has inflation is 2019 was 7.89, which is pretty good. If you see in 2020 is 2.74, means it's very happy, then good money, and economy was very good. But when the war started increasing to 2022, it was 20.55, and it's now it increased. It's more than 25% at the moment. In 2023, it's going up to 28%. So, which it means there's a crisis, in the country. So we know it's a war. So every time we have a war, that's going to be a situation. Especially, and then we see other scenario in Pakistan. Inflation rate is also more than high. If you go back to 2018, 5.8 is very good. It's a 5%. Around in 2020, it was 9. It was increased 21, 9.5. Still not bad, but now they are more than 25%. So because of the poor economic policies, unstable government, natural calamities, all natural disasters, we can say these all impacted on our Pakistani government, and this the poor planning. The major reason GDP is gone down because they have more importing duty than export, so they have less production, and then more importing, so they're spending money is more. And whatever the revenue generate from the country is, they all spend on the defense. They don't eventually divide the money into developing infrastructure, inventing for investors, so that's the major drawback of the Pakistan community. Now we see that the inflation 25% has gone up, means there's no power, and if somebody wants to buy candle, it costs like usually 5 rupees in Pakistani rupees. Now it's cost 20 rupees. And also there's less supply and more demand. And also vegetables, any food products is gone high. It's a shortage of food as well. So this is a major thing we can cover up. And then, well, let's see Austrian commodity inflation, how it's impacted. So if you go back to 2020 before pandemic, it was like less than 2%, which is pretty good. Like, you see the bank interest home loan, it was just 2.5 to 3%. For mortgages, that's per annum, that is. So which is pretty good actually. All cost was good. I know people were happy, good prices, cars, they have good life. But during pandemic, the inflation has gone up because the government was pumping money, and then after they started recording 2021, November, December was when international gates opened, lockdowns are finished, we got a vaccine, and everything is getting normal. And then started increasing the prices, and that's why you see the inflation has rates going up. And 2023 is nearly 8%. Like in January first quarter, we can see it's almost 8%. But people are panicked, like saying, hey, it's keep increasing, so what's going to happen? Is going to increase or decrease? And they don't know what's going to happen. But thing is to settle. It takes time to settle down during the over the period of the time, because it depends on the any other factors. Like we come through the pandemic and again immediately the war, so these all things impacting. It takes time to settle down. So it takes like by 2025 end that like we might go up to 3%. That's what the Australian inflation is at the moment. Let's see the time value of money. What's time value of money? It's very important for the investors to like they have to know what is the time value for money. So today's $1 is not the same for next year. So how we know that how much the value of our dollar in next year or next dollar like for 5 years. So for example, if you want to do a fixed deposit with the a bond, say you want to buy a treasury bond, say from the government of Australia or any of the government. So they give, like for instance example, they give 7.5% rate of interest, fixed one up to 10 years. Now if you want to buy the bond, you have to see this 7.5% is right or wrong, good, good money or not. So if you invest $100,000, so you get $7,500 per annum interest. But if you see the inflation is 8%, so when they give 7.5% next year, if the inflation is still 8%, then you're into loss. So you should not be investing that 7.5% rate of interest. You should be minimum 8% because the dollar value is the same next year. Because it depends on 8%. If inflation is 5%, then you should be in benefit, like so you'll be earning 2.5% more. So you have to just look at the inflation rate before you lend money to somebody. So that is what, even if you invest money, say for instance you want to invest 100k, thousand, $100,000 in stock market, you should be investing at least eight. Remove the 8% plus whatever the profit you want to earn. So if you want to earn profit of 10%, so you should think that dollar value is $100,000 plus $8,000 inflation plus the 10% top of it. So you should be earning $18,000. So that way you get your $10,000 profit. That's 8,000 already. It's inflation. That's a dollar value. That's how the money works. That's what I gave examples here. So yeah, and then let us see the comparison. In olden days, we see that our forefathers tell us like, hey, in the during our time, we used to, the family was only $100, but we all like big family survived, and we had a good food and a good lifestyle. We used to with $1 we get the bunch of vegetables. Like these days, it's nothing. But see, in 100 years, like if you go to 1925, it's nearly 98 years back. So $100 is worth of $4,863 today's rate. So yeah, you should be surprising. Like that's how the wages. So those days, $100 wages equal to $4,800, which is quite normal to run a family. The same, only the lifestyle has changed, the technology has changed. So we are investing in more technology, like buying gadgets and all those they don't have. So this only they live for on essential things. And also you heard they bought a piece of land, acreage, land, farmland or house for $10,000, but it's nearly half a million now. So it's the same value. Let's see the how that impacts, like how do they calculate the dollar value. This is done through the consumer price index values called CPI. So for instance, today you have to take the today's CPI divided by the year which you want to check the CPI. So that's say, if you can Google this, wait, these numbers I got from online. Just say today this year's like CPI is 136 divided by 2.8. That into $1 is equal to 48. That's how I got the figures from. So you can use this formula. Let's see the CPI in more details. Like what was the CPI in 1925? So it was like 2.8, and how that the inflation was there. So you can see the inflation is goes up and down. It's regardless of the CPI increase. So CPI increase like was 2.8 and inflation was zero. So that's pretty good. And you may see in the 1927 the inflation was minus actually. So minus 3.5 is pretty good. Like if they're wealthy people. And then it increases, like I've seen like in 1960s the Australian inflation has gone up to 15% as well. But if you go back to 2016 17, it's pretty good, like inflation, and up to 15 16 7, very good. Just under 1%, which is country was prospering actually, where the GDP might be more high. Let's see the future, the current and the future. So these CPI points going to be increased 139 to 171, and in 2025 expecting 142.92 points, means that's the more inflation is going up, maybe the chances are going up to 10% maybe, or but as per the index is saying, which nothing to do with the points, it has to be inflation might go down, depends on the economic policies. During this year, as per the latest survey, this says because the price is going to be high, the inflation rate is going to go high, and Australia might go into recession. Like it is separated first quarter to between second quarter. The less 70% chance of going into recession. So we'll wait and see. And oh yeah, what are the good investments during inflation? So yeah, yep, because you can't buy much properties, unless and have wealthy. If you depend on the bank, rate of interest so high, maybe the borrowing capacity is low. Capacity is low, but whatever the income you have to secure for future. So invest in the passive income. So we talk about the passive and active income. So whatever the active income is, a job or income you get it through, with that job, keep some savings, like at least 10% of that. Your income, put it into passive income from now onwards. That's make a habit of it. Like you can invest in stocks and trading, crypto, indexing, life insurance, exchange transfer funds, those ETFs, mutual funds, real estate, if you can, bonds and bills, and P2P lending. P2P lending is just lending to some private parties to online, on a high rate of interest, like up to 18%, 20%, whatever it is. Okay, guys, let's go to this small assignments. I hope you understand the inflation in overview. It's just we want to really understand in deep into the inflation. Just if you have understanding investing point of view, that's enough. Please go through online and then work it out yourself. And just it's good exercises that pick up any two countries, see what are the inflation rates, prepare a comparative table, and then yeah, so take the CPI, put the inflation how I did, and also just look at the time value for your own country of any currency. So this is a good exercise, people. So hope you enjoyed the inflation session today, and good luck in your investment.